Welcome, traders. Thanks for following Hooked Up Trading. My name's John. Today we're going to be talking about protecting your portfolio, a few different risk management strategies, sizing your positions appropriately, how to planning your trades, due diligence, and protecting your profits. When it comes to protecting your portfolio, you're going to want to plan out your trades beforehand. When you plan your trades, you're going to want to find your support and resistance levels to find significant price points. Those support and resistance levels are going to be key areas to buy and sell, and they're going to show you where you can take profit and where you should cut losses. And all the in between doesn't really matter quite as much, it's just time going by. But those support and resistance levels, they're going to be consistent over time, and they're going to help you with your buying and selling. And if you plan it out beforehand, when the price reaches those levels, you already have an expectation on what to do when it gets there. And so you're not guessing when it gets to the top. You already know that's your expectation of where it's going to be, so that's when you get out, or that's your expectation of the bottom, so that's when you buy. The most important aspect to protecting your portfolio, I believe, is going to be calculating risk. There's a few things that go into calculating the risk for your trades. The first and most important is going to be your exposure in that trade. That really just comes to how much capital are you putting into it. And next big factor is going to be the risk related to the catalyst. Earnings calls are going to be one of the most risky catalysts to trade options on, because the majority of earnings calls happen pre-market or after hours, and so you cannot trade shares until after the initial reaction to the earnings report already happens. The next thing that you want to consider is going to be the potential downside and the potential upside in those trades. Is it worth it to risk $100 to make $100? Is it worth it to risk $100 for $200? Those are some things that you have to decide, and while you're not always going to lose or make exactly what you're expecting, you can have an expectation going into the trade of what you might lose or what you might gain. The next thing you need to take into consideration is how you're going to size your positions. If you're trading shares or if you're trading options contracts, the size of your positions are going to be a little bit different. If you have a large account or a small account or a medium account, your position sizes might be a little bit different. If you have a smaller account, your positions might take up a larger percentage of your account just because that's where you can afford to start. If you have a large account, your positions might be a lot smaller percentage, because just because you can afford 20 Apple contracts doesn't mean that you should be buying 20 Apple contracts. You should be sizing your positions based on calculated risk as well as the size of your portfolio. Catalysts carry different amounts of risks. Earnings are definitely the most risky, because you can't trade options while the earnings call happens most of the time. Other events like product launches and things like that, they're a little bit safer because they usually happen during market hours, and so you can watch the charts as the markets react to the event. If you're looking for a customized plan for position sizing, that's something we can discuss in a one-on-one trading session. Position sizing should also kind of be related to your total worth. I have about the same in cash as I have in long-term holdings, and as I make profits, I add capital to both of those. When I make profits on options or I make profits on pennies, I move some of that money into my long-term holdings or into my savings account, and that way it's protected and I remain trading about the same amount of capital every week. And that helps protect your portfolio also, because these options trades are a lot more risky, and day trading those penny stocks and swing trading those penny stocks, that's a lot more risky than what I'm holding long term or just having the cash in my bank account. And so when I do make profits, I take advantage of it and I put them somewhere safe and I continue trading with where I was beforehand. And then when I break it down a little bit further, you can see that my long-term holdings is a little bit more than double what my swing trade account is, where I trade options and penny stocks. And even further than that, I limit what I actually put into options at one time because there is the risk that you can lose all of it at one time. And so I have an amount set that I'll put in for options and an amount set that I'll use for penny stocks. I'm not always in both types of trades at the same time, but I do try to be very disciplined about how far I go into any of these trades at any time. And then we can take it and break it down even a step further to where I day and swing trade penny stocks versus options. Now these don't necessarily mean that I'm trading 3 different positions at one time. This is just I have that much capital set aside for overweight positions, that much set aside for average positions, and that much set aside for small positions. And maybe I'll have 2 or 3 of one position and one overweight position, but this is more just how much capital I'm willing to put into the type of trades based on how comfortable I am with them. And so based on my position size, like the capital to my entire portfolio is directly related in that way. If I'm not extremely confident in a trade, I can take on a small position. And when I take on that smaller position, because it was more risky if I end up being wrong, maybe I didn't make as much, but I also didn't lose as much if I was wrong. And again, the amount of capital there isn't really directly related to how many positions I'll hold at one time. That's just about the size I do for my swing trade portfolio. And as you can see on both of them, there is always cash left over. I never go fully invested all at one time because things do happen. Nothing is ever 100% guaranteed in the market, and sometimes there will be a major market event that can tank the entire market. And if you're holding your entire account full of options, when that happens, you can end up losing your entire account overnight. And that's not something that you want to happen. So I always keep about at least a third of my trading capital available so that if something bad does happen, I'm still in the game. I don't get eliminated just from that one event. The last way that you can help protect your portfolio is going to be exiting your trades on time. Whether you're taking a profit or taking a loss, it's crucial to exit on time. You have your support and resistance levels already drawn in your key areas of value where you should be thinking about buying or selling. And when the share price gets there, all you have to do is do it. When it comes down to it, just follow the plan. Trust the plan you made, trust yourself, trust your research. Accept it if you end up being wrong. The only way you're going to find out if the strategy that you come up with works is if you see it through to the end. Sometimes it hurts a little bit, but I can tell you I've been more upset about taking a loss that I didn't have to take when I didn't follow my plan than I've been about taking a loss because my trade didn't go as expected and I exited on my stop loss point. So if you follow your plan, it's going to take away a lot of the frustrations. And if you do the work, you'll probably be right a lot of the time, and you'll start to trust it more and more, and it'll make it easier to follow your plan too. That's all I had planned for the video today. Thanks a lot for watching. Thanks a lot for following Hooked Up Trading, and let's have a good trading week.